gamma levels. Yeah. I'm probably writing them down real quick. Just take a screenshot and then you can add them to your chart later at your leisure. Here's the SPY. NDX. Somebody asked me about how to take pictures. You can go to the Windows Store and you can get screen taking apps for free. I don't use a free one though. I use one called Snagit. It's worth every penny from TechSmith. I use it to journal my trades, to share charts with people, just about anything you can imagine. I got a subscription for my wife because we use it so much every day. It's absolutely.
Hey, Sig, can you hear us? We can't hear you.
You can't hear me?
No, we can't.
Okay. Super low, huh? Let's see if this helps.
Oh, that's much better.
I appreciate the heads up. I could have gone a good 30 minutes before somebody said something, and those are always frustrating days. So appreciate that. That's Snagit though. That's the way to go. Take some pictures. It's not free, but it's hotkey accessible. It saves your picture without you having to tell it to do it. You get the ability to annotate your charts and save your color design and setup. So it's man, it's useful. I use that thing every day. That way, when I show these spot gamma levels, you can just take a screenshot of it and you can go back and write those numbers into the chart, draw your lines. So we're risk on, green on the screen around the world, but not by very much. We're still in a hurry up and wait mode. We've got the rest of the week's economic data today. They're just throwing everything in to the kitchen sink. The biggest one is going to be the jobless numbers. Yesterday, we were watching the FOMC minutes looking for anything that might change the market's perception of that dovish Powell and this exuberant upside move that we've saw since Powell and CPI and PPI. And we saw the unwind begin a little bit yesterday. So our current rate is 5.25. We can see this 5.25. It was at 100%, and they unwound just a little bit of it yesterday. Started pricing in a rate hike, not a cut, not a pause, but a hike. And that's a change, right? Because these were set, nearly at 100%. And now they're unwinding that a little bit, and they're starting to price in a hike. When we get into March, May, and June, the rate cut that they had already started to price in, taking us from 5.25 down to 500, has decreased a little bit, and we're starting to see that rate hike showing up. Now, the thing is, these are really minor numbers for a hike. It's really not perceived that the Fed is going to hike, but the main takeaway here is that maybe the market is hearing the Fed when the Fed continues to say, we're not going to cut anytime soon. Sure, we may not hike either, but we're not going to cut. We're not going to cut unless something breaks. And so when the minutes came out yesterday and we were looking to see if the Fed would, in those minutes, would have enough information to make the market reevaluate this cut, yes, to a minor degree. What will help now today is these jobless numbers. Last week, we saw some really good jobless numbers, and bad is good and good is bad right now. So the market wants to see bad job numbers just because it will reflect that the Fed is doing their job or they're accomplishing their goals, right? They want to cool off this quote overheated economy, whatever. They want to cool things down in the labor market. And so seeing these jobless claims rise, which is, that's bad news. People are losing their jobs and filing for unemployment. But that number going up is a minor lag compared to a lot of the other tools that we have that are a major lag. That's a minor lagging indicator suggesting that the Fed is actually accomplishing their goals. And now today we're going to get numbers again. What we want to see is a continuation of last week's numbers, that it wasn't just a one-off, because that can happen sometimes. You just get one data print out in left field and then things go right back to normal. So these numbers today are more important than they normally are because we need that continuation. If they don't come in elevated like they were last week, I don't think the market's going to like it very much. And bad news is good. So we want to see a lot of unemployment numbers today, or the market's very likely going to sell off. Now, I don't think it's going to be, some extreme ripping move to the downside. I don't think it's going to be that bad, but it won't be, a pleasant run into the sun. So when we get into May and June, you can see that there was a lot of changes to things yesterday. The 5.25, 5.5 number really didn't change. It was some of these others, including a hike. They started to price that in just a tiny bit. And they started to unwind that 475 and 500 number. So they started to unwind these two cuts. You can go and check this out for yourself. To find this CME FedWatch tool, just go to Google and start to type in FedWatch. This will be one of the choices that you get. And then just change your FOMC date across the top. There's other places where you can get this data, but that's a good one. It's free, it's easy to find, and you can just bookmark it. So we're looking pretty good. Small caps are making the run. They're leading the way. And then behind that, we've got the NASDAQ at 0.5%. Japan is up on the day. And, Hong Kong is in the green. I guess we can give it the nod for that, but it's not as elevated as I would like it to be if we're going to be focusing on those China ADRs, BABA, Baidu, JD, PDD, maybe NEO and Liato. If those are the things we want to focus on, this isn't up by very much, just slightly in the green. And then dragging its feet behind everything is the Dow. Not too impressive. So tomorrow is a holiday. Markets will be closed, and it's a short day on Friday. Now, it does have the U.S. Services PMI on Friday, so we're not getting every little tiny bit of data today, but we're getting most of it today, including those job numbers, and that's the big one. It does have the estimations here. The forecast is 229. The previous number was 231. So that's what we want to focus on. And when it comes to these, you got to be careful because they'll put out a headline number, and then quietly, when nobody's looking, they'll put out a revision. And it's complete manipulation when they do that. Just shady, sneaky, but they do it. So, it is what it is. You just got to circle back and watch for any of those revision numbers. I heard somebody trying to blame, the White House on that. And look, every president does it. Doesn't matter which party it is. It doesn't matter who's got their butt in that chair. That kind of shady shenanigans happens. So just, it is what it is. We got the 4-week auction today. It's not as glamorous as the 10 and the 20, but all of these auctions are things that I pay attention to. Comes in at 12:30 today, so definitely worth watching the clock. We're getting into that part of year where we're going to be seeing more of this performance chasing talk. I mentioned it a lot back in August and September when we were still higher up, right before we had started that steep pullback. I kind of explained that there's these fund managers out there who have clients that expect them to, at the bare minimum, perform better than the S&P. Otherwise, why do they need a fund manager? They could just buy and hold the S&P. So when we had things like the NASDAQ and the S&P up so significantly on the year, we knew there was going to be a discussion about performance chasing as we got into November and December. Those fund managers are going to have to find a way to at least get above the benchmark so they have something to present to their clients. And it very likely isn't going to be from the mega market cap names that got us to this level in the first place. That trade is so crowded right now. And a lot of that trade was just a carry trade proxy rather than carrying and holding bonds. They were holding that. The cost of carry for the bond trade was just so exorbitant, expensive, that it was cheaper to do a trade in the mega market cap tech. Well, that we're seeing a sea change there. Bonds actually trying to come up off of that low. So it's another reason to kind of believe that we won't see performance chasing come out of the mega market cap Magnificent Seven. So durable goods, jobless claims, we're going to get UMich numbers, and then we're going to get our crude oil inventories. You could play USO on that. And as we're going to see here in a minute, crude's moving this morning. And then we've got our auction. ECB speakers, and then Bank of Canada. They missed yesterday on their CPI, so this ought to be pretty good. Whatever we get out of Bank of Canada today ought to be worth a good listen to. That's a full house right there. 8:30, 10, 10:30, 11, and 1. To be fair, that rig count at 1 o'clock, it rarely changes. And when it does, it's usually by just 1 or 2 numbers. I worked on those rigs for most of my life. And really the only time we've seen a significant number of rigs hit the dirt or come online is when they had a whole new fleet come out. And then if those fleets had some sort of recall that put them in the dirt for some reason. We do have a market maker move this morning, so they are hedging in the front end. They're hedging against these job numbers being significant enough to move the market, and that should get your attention today, right? When you think about, well, how bad could it be? It's bad enough, or it could be bad enough today that they're hedging against the move. Two sides to that point of view, though. Every time we hear them say, oh, this is a big one, we could see some really big moves. People go in and they hedge it to the eyeballs, and then we don't get a big move. Well, kind of think about the why behind that. If they're off sides, if they're long and they should have been short, if they're short and they should have been long, then they've got to scramble to cover. And that scramble, everybody trying to do one thing all at once, supply and demand imbalance, and then we make really big moves really fast. But if you're hedged, it doesn't matter if it goes up. It doesn't matter if it goes down. You're not, quote, off sides and you're not scrambling to cover. There's no supply demand imbalance. We don't get a big move. So if they see it coming and they hedge it to the hilt, we're very likely not going to see that big move because nobody's surprised. Nobody's caught off sides. It's surprises that move the market. So could we still see a big move? Yeah, I mean, it can still happen. but it won't be just from that one dynamic, right? It'll be for other reasons. Say like trying to unwind more rate hikes or more rate pause. They'll start pricing in a hike or pricing in a cut. So something to think about. And we can always see if they're hedging by checking out that market maker move up there. Just the fact that it's there, just that we can see it, tells us automatically that they're hedging. My drilling tool is not working today. Wake up, lazy bum. Some days. There we go. So we are just underneath that call wall again. That is a resistance due to liquidity. So it's not just some generic line in the sand or pivot point. There was enough liquidity there that it became the call wall. There's some videos on this if you want to search like spot gamma on YouTube, and you can learn about the call wall, the put wall, volatility trigger, zero gamma. There's so many new AI chat bots. I was using the one on Opera the other day. They've got one called Aria. And I always like testing them out, see how well they do with different things. And I was asking her about zero gamma and volatility trigger just to see if this bot understood what the heck I was talking about. And yeah, I mean, she did okay, not too bad. But you know, Google and YouTube would probably be a better bet. But if you don't understand that stuff, there's certainly more than one way to learn it. And AI seems reasonably capable of explaining it to you in whatever way you want it explained, right? You can tell them to dumb it down and feed it to you one piece at a time if that's what it takes. Nothing wrong with it. You know, it also will translate it into different languages for you. So if you're struggling with it because it's in English, well, tell it to put it in your language. How cool is that, right? So we got the call wall there. There isn't really much of an expectation that we're going to be able to maintain above that level. We can get above it, but to keep it is a completely different story. And the only thing that I think that could really get us there would be if the numbers today have enough push to do it, right? So these numbers that I got on Thinkorswim comes from here. Every day I just come in and I download this. And I've noticed that the numbers that I download here don't always match the numbers from here, right? So that's why I showed this first. This is always the better way to go. And you can see that the ES call wall is 46.12. But here it's still showing as 45.62. Do you know what? I just seen that date. I didn't get it uploaded. Hold on just a second. Let's update that number. I have to go in every day and change these, which is why I put this date right here to remind me whether or not I've updated it today. There we go. They still won't always match, by the way, if you're using their Thinkorswim tool. It's a little bit better than the one that they have for TradingView, which also has to be installed every day. You got to copy and paste the code into it. It's a bit of annoying, but is what it is. So now that I've changed that and updated it, you can see the call wall is rolled up. Yesterday, it was down where we were just looking at it. Now it's rolled up. So now we've got room to the upside, and we can make that room today, even if the numbers aren't helpful. All right. Bad job numbers. Bad news is good for the market right now. It'll send us up. And now that that call wall is moved, we can easily take 4,600 and keep it. We don't have to worry about selling it back off like we had on Monday. So that's kind of good news. That can get us really close to that year-to-date high up here. So rally base drop. We lay in the distal line and the proximal line. That gives us 4608, which is still underneath that call wall. 4611 is the cog line. We've got a voodoo line at 4602. The roundy, which is another resistance all on its own. ADR full, basically at 4,600. And the ADR half at 45.75. I'm just rounding up because round numbers are easier to deal with. Quarter numbers are easier to deal with, whole numbers. We don't have a missed daily pivot, and we didn't keep the one that we had yesterday either. So that's off the table. We got our inside a week breakout, and so far we're keeping it. But this morning is going to be all about these numbers. So no amount of technical analysis is going to be able to assist us with that. Pivot points won't matter as much as the push behind the flow, right? So it's all going to be event-driven moves today, at least through the morning session. The main takeaway is this market maker move. They're hedging it because they're concerned about the numbers. 10-day, 30-minute volume profile. We do have that air pocket of risk still, but we're moving farther away from it. Now, if we do make a move to the downside, we've still got to cut through 45.22 point of control. And then this Globex low at the roundy 4,500. If we do break that 4,500 though, it's a short, sweet 50-point drop before we find any help or assistance. We moved through there before really fast, and that's exactly what it would look like if we came back down through the other way. Now, I'm sure, since we're as high as we are and the numbers come out, it probably won't look exactly like that when we break this, but it will move through there really quick. We also do have on the table today the liquidity gap close play that I like. I didn't keep examples of it this morning, or at least I wasn't prepared for doing examples of it this morning. So this is what we're looking for, a single directional push, and then it stabilizes, builds a base, and starts to close the gap and gets the gap closed usually by 11 o'clock. That was CPI or PPI, non-farm payrolls, is one of those. The same thing here, single directional push. Didn't build much of a base or a topping pattern, but it worked its way back and it got there around 11 o'clock. Same thing here. Kind of get the idea, right? Single directional push, built the topping pattern, worked its way back to the start, got there around 11 o'clock. What we don't want to see is something that looks a bit like this. Runs in both directions, big, wide, sweeping candle. If that's what we get, there is no trade. There is no gap close play. There's plenty of trades. We can always do something. But this one particular trade is focused on a liquidity gap. And that liquidity gap exists because of the one-time framing single direction push. If we don't get that and we flip around in both directions and close near this where we opened, then there is no liquidity gap trade. Even if we do get the candle, the single directional push, there's no guarantee that we're actually going to come back down or come back up and get it closed today. I believe the ones from last week that we opened are still open and that they're not closed yet. So plenty of examples of what it looks like that we don't want. And then I've got a couple in there kind of showing an example of what we do want. Single directional push. And it doesn't matter if it goes up or down. It just matters that it's a single directional push. I tend to start playing this trade after the open. I don't even bother with it until then, because there's usually plenty of room. And if it's not closing on the ES, you might find that it's closing on the NASDAQ or vice versa. So just because one is closing doesn't mean that the other one will, or just because one isn't doesn't mean the other one will. We have a kind of narrow IB last night, but we've got a wide Globex from the overnight. Started at the kill zone at 2 o'clock this morning, took off, and it never looked back. There's a little bit of tell to that, by the way. The kill zone, normally between 2 and 4, that's the kill zone. The kill zone, a lot of times, will get a reasonably decent move. And then by the time that I get in the office around 5, we're starting to unwind that move. And that very often becomes my morning trade, is just unwinding the liquidity from the kill zone. We didn't get that today. It made the move from 2 to 4, and then it just kept right on going, which is fine. It's no big deal, but it's just a change, right? Because normally we don't see that kind of continuation through the kill zone. Good rule of thumb, if we're sitting inside of yesterday's price action, it's probably going to be a choppy day. If we're sitting inside of our own Globex price action, it's probably going to be a choppy day. So with this really wide Globex, what we want to see in the RTH when we finally get there is that we get out of this range. If we stay in this range through the day today, it's probably going to be a choppy, nasty day. And just for an example of that, look at yesterday. We opened at the edge of our own Globex range. And when we went below that, it was great, beautiful trading. But when we got back up inside it, all we did is just chop about for the rest of the day. Now, it was tradable. It wasn't fantastic. And that's a really tight, choppy range. I heard from a number of people yesterday that got ripped up right there in the first 45 minutes yesterday. And it wasn't much better after that drop down. It just chopped about again. You know who you are. No VPOC to carry forward from yesterday. And the one from Monday into Tuesday, we took out in that drop down where we chopped about yesterday. So it did its job. We're done with it. Take it off the board. We are still surrounded by a lot of VPOCs, though, in each direction. So one of the things that I would recommend we do today for various levels is mark out Monday. Monday is the candle in control. Holding above that 50% gives us license to continue moving to the upside. Sitting inside of Tuesday's price means that we can mark out Tuesday's levels as well, because you can always look to the left and capture the last candle. That puts us inside day, but not yet IX10. If we were using OCR analysis, we've got a defined wedge here after Monday's really big candle. Higher low and higher low, lower high and lower high. So we're forming a classic wedge, and in OCR, that counts, right? If we were not using OCR, we'd need a lot more candles. So you can play this trigger multiple ways. I wouldn't play it without the job numbers today. I wouldn't play it without the econ. Otherwise, you would play it just like any other wedge pattern. And usually there's an edge to a wedge, right? You'll get a rising wedge, those break to the downside. You'll get a falling wedge, those break to the upside. But when you've got more of one of these kind, there's no real edge to it. It can break either way. One thing is clear though, when you get that kind of a wedge, is that you measure the broadest part of the wedge and you project that higher and lower. So we already know, measure Monday's candle. A, it's the biggest candle that we've got in this collection of candles, but B, it's the widest part of the wedge. So multiple reasons to believe that measuring Monday's candle is the right thing to do. When we measure that and plot it to the upside, it gets us around this 4,600. Interestingly enough, when we measure yesterday's range and plot it to the upside, 100% of that move gets us to the same spot. So 50% of Monday's move gets us there. 100% of Tuesday gets us there. You know you're drawing your levels in the right spot when they line up with everything else. (1.4% above the 10-day moving average. We're kind of flattening out here. We're not continuing this move back to the 10, which isn't necessarily a bad thing, but it does kind of imply that we're going to get what we had back here, which is where we came towards the 10 and then drove back away from it without ever touching it or crossing through it. Either way, we're not overbought. We haven't moved too far, too fast. It doesn't owe us a pullback. And so linear regression and least squared methods and dot plot statistics, none of that suggests a sell-off. Here's the 10-week moving average, and we're 3.25% above the 10-week. Now that's a little different. You know, when it comes to considering that question of being overbought or oversold, we've seen higher than this. Certainly, we can look to the left and see, you know, even back in July and August that we were at 4.5% and 5%. But we are at that level where it generally stops. If we think about the average rather than the extreme. It does if it was a bullish gap. Otherwise, it would be a more bearish, right? If it was a downside liquidity gap, then it would mean that the market is more bearish in the near term or the short term. Yes. Just because of what it implies, right? Like, or the whole idea of why the gap even is supposed to be closed. When we move so fast like that, when the econ comes out, it creates like a liquidity vacuum. You know, the lack of creates the vacuum. And we expect that vacuum to be filled, that void to be filled by retracing our steps and seeing the gap close. So when the gap doesn't close, then it just implies that there's so much aggressive drive for more that positions still need to be filled, that it'll be very bearish in the near term if it was a downward move, or very bullish in the near term if it was an upward move. And I think we really saw that last week, right? Last week was a great example of that, where we had that Wednesday big drive. Was it Wednesday? No, it was bullish, so it had to be Tuesday, right? Yeah, there it is. How can you miss that? We had that big bullish drive, and that liquidity gap is still there. And the bullishness in the near term was that even after such a massive move, it continued to hold that line and continued to drive even higher. When normally after such a big bullish aggressive move, we would have expected it to try to retrace, right? Even the next day or the day after, we would have anticipated some sort of retracement, and it didn't. It just kept going and going and going, way beyond everybody's expectations, which is where that old phrase, the market can say irrational longer than you can stay solvent, or some kind of phrase like that. It has been a serious change in market dynamics, right? And it was a little hard to spot at first. Not the flows. The flows were easy to spot. It was keeping it, believing that we were actually going to keep it and keep going. And it's been a pretty fantastic run. They're continuing to expand on that market maker move, by the way. Since I started 30 minutes ago, we've seen this increasing. So we are we're at the average spot when it comes to how far away from the 10 we want to get. So it doesn't qualify as overbought, but it does qualify as this is the spot where we generally stop. We stop and we let the 10 get caught up to us, and or we stop advancing and we start falling back towards the 10. Either way, we're at that level. So we could get a little more out of it, certainly, especially on today, where we could spike higher away from it. But it's not expected that we're going to keep it. And that's kind of important, right? That even if we do drive farther away from it today, one of two things is likely to happen: that we're going to pause after that and hold the line until the 10 comes to us, or we're going to drop down and move towards the 10, because we don't keep that distance, right? That's a given. One thing is absolutely for sure is we won't maintain that distance from the 10. We're going to close it one way or the other. And it's not binary. It's not either or. The 10 can continue to move towards us even as we continue to move towards the 10. So, it doesn't have to be one or the other. It can do both. There really isn't a reason to go through the quotes this morning and look at the various sectors and what's going on out there, because depending on how these numbers come out, we're going to have a bullish day and everything is going to be a part of that rising tide, or we're going to have a bearish day and everything's going to be a part of that falling tide. So there's really not a lot of reason to spend effort digging through what is down and what is up. But it is worth talking about a few things. Crude started to shake a bit. So take a look at crude. That is a significant move in crude. I'm on a 2-minute chart, so this, it really stands out. This was based on some OPEC news that came through Finance Juice. You can see right there. I love it when they do that. They make it really easy to see. Bright red box. They show the before and after, and it links to your trading view. So if I was to click on this, it would want me to log in the first time I ever click on it. But after the first time, you can click on their charts as they pop up, and it'll go to your trading view, which is cool. So energy is important to the market. There's so many different ways that we can look at that with ratio charts, correlated charts. But the long and the short of it is energy matters. And it's very likely that we're going to fill this. Now, I don't think that we need to go through and kind of, work out the swag levels for what we think is going to happen to the NASDAQ or the S&P if this continues to move to the downside. But what I would focus on is this had started to move up. We were starting to get our move up off of these lows. And now we're getting the right shoulder to this inverse head and shoulders down here. And that tweezer bottom so far is still sound. My concern is we've already crossed the half back. So if we measure just that right there, we've cut through that level, which is concerning. If we run it the other way, it's even worse. So when we look at where energy has been coming from since October, this has just been a continuous, consistent, persistent move to the downside. And even this pullback did exactly what a regular pullback would do if we were just going to continue to move to the downside. So this move up here with that tweezer bottom, which kind of signaled, we had that micro double bottom and then the tweezer double bottom, or the tweezer bottom kind of implied that we were going to begin working our way back in the other direction. This has shut that down completely. We do have a fantastic TRB setting up, this really, really big TRB, but we don't have it yet. And now we've got to get through 80 to trigger it. So if you're looking for an energy play as a swing and you want to do it with, a real quote tells, we got to get through 80. If you're looking for an LRE, then you want to try to get in somewhere between 72 and 74. You're going to want it as low as you can get it. Now, Bitcoin made some fantastic moves and it's holding these highs. It's holding the highs, but that's about all we can say out of it. I don't like that it's below the 50%, but it's still just a topping pattern until something changes. If we're using OCR, not even OCR, if we're just using pure price method, then we've got some warning signs here. We've got a lower high pivot. We don't yet have a lower low yet. But there's a little trade strategy called a 1, 2, 3 fail. And just like it sounds, when it comes to a market that has set a high, and then it fails to set an equal high or a higher high, that's 1. If we do that again, that would be 2. Very often it doesn't even do the third. It's just 1, 2, and down we go. But it's called a 1, 2, 3 fail. So we are looking for that third one. But first we got to get the second one. And you could look back, to here and consider that this is 1 and that is 2. I don't consider that because we had an equal high or even a higher pennies count. So I guess we could zoom in and focus on, but that's an equal high. So I don't count this as 1. I count this as 1. Equal high is fair. The market will take it, but it has to be equal or higher. So when it comes to Bitcoin, we are holding the highs and we don't have a bearish signal yet. So LRE would say short it across those highs or wait for it to break 3,500. At least if you let it break 3,500, you've got a trade with, a tell or a signal or a setup or a strategy. Pure price method would be getting that lower high, or excuse me, that lower low, and then getting that lower high. So we get US dollar Japan up this morning, which means we should not have gold up this morning, but we do. Now it's giving it back a little bit, but we can see US dollar Japan here. We had that sell-off in US dollar Japan, and we just looked at gold also having that same sell-off. They're not supposed to be moving in sync. They're supposed to be moving opposite of each other. Bonds are up and stocks are up, which means we have yields down, and we kind of have dollar pulling back, but it's actually up on the morning. So we need this dollar to continue to move to the downside, and preferably we get that move to the downside in the dollar with this continuation in yields to the downside. We get them working together in sync. This drive to the upside can stick and hold better. Careful with that NASDAQ. It is getting a bit extended from VWAP. It might want to pause and wait for the ES to get caught up a little bit. So one thing we can do, since going through the numbers, looking at the names that are gapped up this morning isn't really going to be useful, we could lay out the argument for what happens if we actually do get bullish today. The target is going to be ADR half, 45.73. That'll get us through this current weekly high. We get through the ADR half, then we'll target the ADR full at 4,600. That would be a 40-point move from our current location, and a good move, right? Because we're already up 10, add 40 more to it. That's a 50-point move. That's our full day. And it's not even giving us the market maker move at that point. So we could go another 10 beyond that, which would get us close to the call wall and give us our full market maker move as well. That'd be the highest end of the game, right? To the downside, we want to focus on getting through that daily pivot point, then our own Globex low, back inside the previous week's high, the ADR half at 45.22, and then the volatility trigger. That volatility trigger is like cement. I really don't think we're going to make it through there in a single day or with a single shot from this distance. So a move to the downside, really don't see getting past 4,500 unless those numbers are so absolutely drastically horrible that that we make a stronger move than I see on the horizon at the moment. If we do make it through that vol trigger, though, we got the 10-day moving average down there. We got the round number 4,500. We got some voodoo lines, the cog line at 45.11, and we have that full ADR at 44.96 with zero gamma and a weekly pivot point at 44.90. That's so many layers of support down there. There's just no way we're getting through that. No way. We could hit it. We could wick through it. There's no way we're getting below it today and keeping that I don't care how bad it gets. There's no way we can do that. It would have to be the start of a new war to get us down below that level. You know what I mean? Like, it's going to have to be bad, really bad, which is kind of a good thing if you're thinking about some 0-day trades. That's just a lot of noise. So you're looking at about $60 from where we closed yesterday. That would give us our ADR and our market maker move. If we round up and say we closed at 45.40 and you add 60 to that, that gets us 4,600. That's simple enough. Take it the other way, round up to 40 and then take 60 off. That would put us at 44.80. Now, these prices that I'm about to show, they're not accurate because we're still not open yet, but 44.80 is not that expensive, less than $30. And that number will change before the open, but you kind of get the idea. Normally you look at the SPX and it's a couple of $1,000 for a trade. So, you know, if you're talking 20 and 30 cents, that's not too bad. And then 4,600 on the other side. Now, Tom Sosnoff has mentioned more than once that you kind of want to avoid trading round numbers in the options market, especially the cost of the option itself, like $1. He had a phrase to that once. I can't remember what the phrase was, but basically his summary idea behind this is people hate math. Most people suck at math. And when it comes to running the optionality numbers, it's easier to do the math if you're trading a round numbered option like $1. And crazy thing is, he said, as much as that sounds ridiculous, that people would pick their strike simply because the cost of that option was a round number like $1. He said they do it anyways. And he would know the guys stared at, you know, options markets. He literally built the tools that run options markets. He's like the smartest guy I've ever met when it comes to options. I heed his warning. So if it's a round number, $1 round number, nice and flat, don't trade that one. Just look up and down the chain, find a different one to trade, like that one right there. It was just at $1, 45.20. Either way, the point of coming in here and looking at these is that if you was to do a lotto play, and these have become kind of popular on the buy side with what I'm about to talk about, it's these low win rate trades. And remember, the market in options is very fair and balanced. If your chances of success are really low, so is your risk. But if you have a really, really high chance of winning, usually your risk is really, really high too. And the easiest way to keep that in your mind is think about walking into the gas station and buying a lottery ticket. Somebody is promising to make you a millionaire for $1. Your chances of winning is snowball's chance in hell. But if you do win, it's fantastic, right? So really low risk because your chances of winning are really, really low. If you always keep that in mind in options trading, you'll understand the prices that you're looking at. So this out of the money, really cheap option at 4,600 and at 44.80. Sure, it's really cheap because the chances of it actually being a big blowout trade are very low. But right now, in this environment, we're making big moves. I mean, look at yesterday with that fantastic, gigantic move. I tried to fill a really expensive call yesterday, or a really cheap call yesterday. And I didn't get filled. It was somewhere right around in here. I tried to get that call. I didn't fill, and it fell away. And I thought, well, it's good I didn't fill it. And then I was trading futures, and I didn't get an opportunity to trade calls in here again. I just stayed in futures after that. But the point is, you can get a really cheap option today, extreme, way out of the money stuff. And if it doesn't work, well, yeah, you know, it was a cheap trade. But on a day like this, what you don't want to do is get something that you think has a chance of winning, right? Something at the money. Don't get one of these really expensive, these prices need to update, but don't get one of these expensive at the money options that you think has a chance of winning, because they're just going to lose a lot of their value from the Greeks. It's going to get stripped out of it. It's going to be a difficult trade. If you do want one of those kind of trades, don't use a 0 day. Use 20 to 30 days out, you know, and then do it that way. I'm probably going to get a 4,600. I might get a put. Really, it just comes down to the job numbers. So That's what we're going to focus on. Everybody, be careful, be safe. Have a great Thanksgiving. I don't think I'm going to come in Friday for the morning briefing. It's a half day. I'll see you all on Monday.